appeal action in Britain. It's over a claim that thousands of businesses using cloud computing services provided by Amazon, Google and Alibaba could be paying higher license fees to use Windows Server software. A case was filed at the Competition Appeal Tribunal on Tuesday. It claims that British businesses and organisations could collectively be owed more than $1.2 billion in compensation. Separately, Britain's competition regulator is investigating cloud computing, a market dominated by Amazon's AWS, Microsoft's Azure, and, to a lesser extent, Google Cloud Platform. It's due to update on its investigation imminently. Microsoft in 2020 introduced new license fees for running its software on major cloud providers. The claim alleges it then used the fees to induce customers to use its Azure platform. The United States Federal Trade Commission last week opened a broad antitrust investigation into Microsoft. According to a source familiar with the matter, it included its cloud computing business. The FTC is examining allegations the software giant was potentially abusing its market power.
The S&P 500 and Nasdaq eked out record closing highs on Tuesday, with tech-related shares extending recent gains. While the Dow dipped almost 0.2%, the S&P ticked up slightly and the Nasdaq added 0.4%. A report on Tuesday showed U.S. job openings increased solidly in October, while layoffs dropped by the most in 1.5 years. Two Federal Reserve policymakers categorized the job market as solid and said they see inflation heading down to the central bank's 2% target. But neither indicated whether the Fed would deliver a rate cut at its policy meeting later this month. Traders expect a more than 70% chance of a quarter-point cut. But Adam Coons, chief investment officer at Winthrop Capital Management, thinks the odds aren't that high.
So right now, I would say it's a coin flip as whether the Fed cuts one more time in 2024. I would lean towards I don't think it's necessary, and just because I think the economy is showing too much strength for there to be a need to cut right now. In 2025, I think it really comes down to what is the economy doing.
Investors will closely monitor Friday's monthly non-farm payrolls report for further clues on the Fed's next move. Stocks on the move Tuesday included Salesforce, which, while up marginally at the close, jumped another 7% in after-hours trading after beating Wall Street estimates for third-quarter revenue thanks to strong cloud demand. Shares of Amazon rose after the company announced a new slate of AI platforms known as foundation models at its annual AWS conference. And shares of Tesla closed lower after data showed that sales of Chinese-made electric vehicles fell 4.3% year-over-year in November.
Global investors have always valued South Korea below other markets. The reasons vary from tensions with the North to the tight structures of its conglomerates. Politics this week gave them cause to deepen that discount. Korean stocks fell and the won plunged to two-year lows on Tuesday, after South Korea's President Yoon Suk-yeol shocked the world by declaring martial law. The impact was short-lived. Parliament overturned the ruling within hours and markets stabilised. But for investors, it was a reminder of the reasons Korean stocks and the currency have underperformed global markets for months. Korea's legendary discount refers to how cheaply stocks in the Kospi 200 index are priced relative to the assets companies hold, known as the price-to-book ratio. A majority of companies listed on the Kospi trade at a price-to-book ratio below 1. In comparison, the MSCI World Index trades at a ratio of 3.5. There are a few reasons for Korea's perpetual discount. One is the risk that comes from long-running tensions between North and South Korea. Another is the nature of its business, dominated by opaque family-run firms that seldom give out generous dividends. The discount deepened this year as investors fretted over how exposed Korea is to China, whose anemic economy now faces fresh US trade tariffs. Foreign money has been leaving Korea's stock market since August, with outflows in 4 months topping $14 billion. While authorities scramble to prop up the won and calm financial markets, investors are still anxious about what comes next for the currency.
Larry Fink's BlackRock announced a major $12 billion acquisition of private credit firm HPS Investment Partners on Tuesday. The all-stock deal to buy HPS expands the world's largest asset manager into the red-hot market of private credit, an asset class expected to grow to $2.6 trillion by 2029. Private credit, in which institutions other than banks lend to companies, has seen a boom in recent years as stricter regulations have made it costlier for banks to finance riskier loans. Fink, who co-founded BlackRock in 1988, has previously outlined private credit as a future growth driver at the firm, saying it could mitigate the economic impact of high U.S. government debt and wide deficits. HPS, once part of JP Morgan, is a massive player in the private credit space with about $148 billion in assets under management. BlackRock manages $11.5 trillion in assets with an existing private credit platform of $85 billion. The deal is the latest in an acquisition spree for BlackRock, which has spent roughly $28 billion this year on deals integrating public and private markets. The move also comes amid speculation Fink may eventually step down from leading BlackRock, despite saying recently that he was not thinking about retiring. Shares of BlackRock rose in Tuesday morning trading following news of the deal.
A robot like this could one day take over your household chores. Meet Neo, a humanoid robot powered by artificial intelligence. The prototype is the brainchild of 1X, a company based in Norway and Silicon Valley.
In the long term, this will be doing your laundry, cleaning your house, tidying, and generally giving you back a lot of time in life.
Neo is one entry into the race to bring humanoid robots into our homes. On top of its job performing household duties, the robot can be operated remotely from anywhere in the world. That's according to Bernd Bornich, the CEO and founder of 1X.
We're really excited about the ability to teleoperate the robot yourself. So if you're somewhere else, you can actually teleport into your robot and do small things in your house that maybe you forgot to do, right? Like feed the cat or close the window, check that everything's okay.
While the current prototype demonstrated for Reuters was piloted by humans remotely, 1X says the market-ready version will use AI and remote control. The company says that version will be unveiled in 2025. As for the price, 1X says they can't reveal those details yet, but expect it to be in line with a mid-priced new car. Bornich said he has been testing the robots at home with his own family, including a previous version named Eve.
And at that point, I would have said that, this is really useful. I don't want to give it back, but I wouldn't pay for it yet. But this is a while ago, right? So there's still some way to go. And we learned an enormous amount from this. And all of these lessons learned went into designing Neo, both the hardware and the AI stack. And we're about to try this again now, and I'm super excited to see the results.
Neo faces stiff competition. Tesla has ambitious plans, with Elon Musk saying its Optimus or Tesla bot will be, quote, the biggest product ever of any kind. In October 2024, Musk predicted a future with 10 billion humanoid robots, priced between $20,000 and $25,000 by 2040. And Beijing-based startup Robotic Era recently released video of its Star One humanoid robot traversing the challenging terrain of China's northwestern Gobi Desert.